So how should you be thinking about the back half of the year? Let's find out and welcome in Alex Saunders. He is head of quantitative macro research at Citi, schlepping in on a Friday, Alex, and we appreciate it. Thank you.
Thank you.
What does that mean? A transition period for the economy?
Yeah, and I think markets have been trading between these two regimes, if I can call it that. One is cyclical fears. As you mentioned, we have this technical backdrop in September. We also have labour markets that our econ team would call fragile. That is an environment that is particularly bad for equities and much better for fixed income. On the other side of that, we have AI, we have a potential for a productivity-induced growth period, very positive for equities, and that's what the market's been trading for the next 4 months. So it's going to be key, particularly, I think, as we go into next week and we see the labour market data, that those cyclical fears are not reignited.
So who would win in that fight? So the positive side of the economy, the concern side of the economy, who wins and what does that mean for equities going forward?
Yeah, so the winners are the winners that we've seen in the last few months. So that is your tech sector, that's communication services. Those are your winners. On the other side, the winners will be fixed income markets. We would see a Fed that would need to cut much more aggressively. I think equity markets, those winners then become the losers because that's in the price to a certain extent. So you would see that leadership flip from the cyclical tech-related names into more defensive sectors.
Like what? What would be a defensive sector, Alex?
Utilities, for example, would be one of the sectors that we think could outperform in that if we do get that cyclical environment. That would be probably our top pick. Yeah. On the defensive side.
When will you know? Like what we get, listen, this is stock market. We get data points almost every day. You had the PCE today, whatever. When do you have like a real clear vision? Or maybe you and your team have one right now?
I would say that in terms of the transition, we're still dealing with tariff announcements and how those tariffs are going to impact the data. And to get a clear read on that, is going to take much longer. That we won't see until much later, probably in October, November of this year. If we don't see any pickup in inflation, if growth still looks strong at that stage, given that those September technicals you had mentioned are out of the way, given that the technicals actually flip and potentially you have a holiday rally, we think that is a very, very good setup for equities. So to a certain extent, we have to navigate this data that we're going to see in September, plus the weak technical backdrop, and then going forward into the end of the year, potentially there's a setup that could be very equitable.
I like a lot of our viewers and listeners are trying to fly. I say trying because Newark's had more problems. Trying to fly this weekend. It sounds like we're kind of on one of those flights. You know them, Alex, where you're taking off and the captain says, "Listen, just sit down. It's going to be bumpy but once we get upstairs, we can kind of continue our service and everybody can take off the seatbelt line." Sounds like September is going to could be bumpy, could be that ascent where we figure out what's going on. But if we clear through that, if we get tame inflation data, if we don't get some crazy tariff headline, sounds like you and your team are saying we might get a market run.
Yeah, that's exactly right. And for now, we would say that stay the course. Keep hold of equities. We remain overweight equities, neutral on fixed income. If you do want a hedge, if you do want the seatbelt for that turbulent period potential, then credit is the place to be.
What does that mean, credit?
Credit, I'm talking about corporate bonds, or it can be CDX. So
junk bonds or like high-quality corporate bonds?
The higher quality corporate bonds will move if we get cyclical fears. We think will move. The spreads are already tight there. So that is the potential good hedge. The other aspect to mention for corporate credit is it's not as exposed to the AI theme, so it doesn't benefit as much if we do get a good growth environment.
So you're not